Good evening, everyone, and welcome to the Business of Property. I'm your host, Cheryl Leong from Property Development Australia. I begin by acknowledging the traditional custodians of the land on which we meet and pay my respects to elders past and present. I extend that respect to Aboriginal and Torres Strait Islander people here today. At the Business of Property, we interview superstar guests in the property development space that share their expertise and their deals and their stories to help empower, build, and grow our community of property developers and investors. So hello to Facebook, LinkedIn, and YouTube land. This is live, and if you're watching the replay, comment #replay on anywhere where you see your comments, and give me a shout out if you are here with us today in the comments section. So thank you for taking the time out, everyone. Before I introduce to you our two very distinguished guests, we're talking about the changes in the Queensland land tax. This has been sort of, one of the topics that's been buzzing around lately. And I think it's really important. Obviously, we have people here who are investors who have property in Queensland, or you're also developing in Queensland, possibly keeping stock as well. So we have Darius Hii and Tony Lee. Darius is an estate planner and tax lawyer and the director of Chat Legal. He provides a lot of structuring advice that involves implementing tax-effective sort of business succession and restructuring strategies. Also very, very well versed in terms of the tax implications of property in Queensland. And then Tony Lee. Tony is not a stranger to the business of property. Tony is a property tax specialist, and particularly in self-managed super, and he's accredited in providing advice in that space. He works with a lot of professional services, particularly also developers and investors. And so we thought, hey, we need to combine these two together. Let's talk about the land tax side of things, the regulations around that. And then Tony will definitely be sharing his knowledge around, okay, what does that mean from a structure point of view in terms of the accounting and tax side of things. So without further ado, I know a lot of you are super excited about law and tax. So let's bring on these two superstars. Darius and Tony, please come down to the Business of Property dance floor. Hello, gentlemen. How are we all today?
Yeah, good. Thanks, Cheryl.
Cool. Hello, Tony.
Awesome. Hello, everyone. Hi, Darius and Cheryl. Super excited tonight.
All pumped to go. Okie dokie. So I know, particularly Darius, we've put together a presentation here, and there is sort of some regulatory changes that we need to know about. So again, a presentation style so people can actually see and interact with it. So let's dive into it. Anyone that's listening in today, please put your comments and your questions in the chat below, and I'll endeavor to bring that up along the way. So ready to rock and roll, gentlemen?
Yep, that's all good.
Let's go.
All right, let's go.
And I'll just let everyone know I'm not controlling slides, so I may just say next for the person to swap the slides. Not yet. I should just give a few broad comments to get started. I'm actually based up in Queensland, so when these changes came through right at the end of the financial year on 30 June, I was kind of a bit keen to see how it all pan out. So I make that comment because when I'm talking tonight, if I'm calling it interstate land, it's not because I'm trying to make Queensland special, but it's because, well, that's what they call it in the Queensland legislation. So what I wanted to do, spend about 10-15 minutes just really trying to make it quite simple. When will this be relevant for you? I appreciate some people are based in Queensland, some interstate, some people with nothing in Queensland, some people with all their assets or their property in Queensland. But as I will probably allude to near the end of today, although I'll spend some time talking about what these Queensland land tax changes means for us right now, as we've seen quite recently with an example in South Australia, when state governments want to find ways to broaden the tax base, at least for land tax, all they need to do is look at what other states are doing. So everything I say right now, maybe another state in 3, 4, 5, 6 years' time, they look at Queensland and go, hang on, that's a good idea. we should try and implement what they did in Queensland in 2022, 2023. So if we can pop onto the next slide, what has really changed? Okay. In short, if you have land in Queensland and you have interstate land, so land in any other state or territory in Australia, the interstate land will be factored in determining whether you pay any Queensland land tax. Okay. A few things I'll just quickly point out here. Remember, everyone, land tax is something you pay once a year. In Queensland, it's something that gets assessed it gets assessed in about September, but it's based on what you own on 30 June each year. Okay, so we have effectively another 10, 11 months until we really have to care about these changes. However, if what you hear today makes you think, I don't want that hassle of owning that random block of land in Queensland, you've got some time. You won't get a bill for this financial year. It'll come next financial year. Okay. One other brief thing to mention, although these changes have passed, they will officially become law in January. Okay. So if you try to look it up yourself, you won't see these things online. Okay. It's a bit of a lawyer's trick to find the information before it goes public. Okay. Next slide, please. So I just want to refresh everyone by saying, or your memories at least, by saying, this is when we don't need, or this is when we need to start paying land tax in Queensland. If you're an individual, you can have up to $600,000 worth of land and not pay any land tax in Queensland. If you have a trust or a company, or in fact, if you're a foreign individual or an absentee, in more specific terms, you can have up to $350,000 worth of land. Now, when I talk about land, I'm not talking about how much you paid for the property. I'm actually talking about what the government values that underlying land to be. So sometimes when you get that rates notice, you might get a little comment saying what the government has valued the land to be. That's the land that is assessed here. And the big thing to appreciate with land tax is they look at all the land you have, they add them all up, and then you levy these tax rates against you. Okay. In the other states, which is on the next slide, they do have different thresholds, and that's because every state has different land tax rules. In New South Wales, you can have about $822,000 worth of land and not pay tax. Sorry, I lie, you pay $100, but that's just a flat rate until you hit that $822,000 benchmark. Everything above that, you're paying about 1.6% tax on the excess. In Victoria, you can have up to $300,000 worth of land. South Australia, about $500,000. WA, about $300,000. Every state is different. And without trying to foreshadow things, is because every state is different. There's not a lot of information sharing. There's not a lot of thought about, well, what happens if people use different states, goes across the different states, which effectively just says, well, here's what the old rule says. And on the next slide is the key example that often what people would ask me. They'll say, look, Darius, does that mean I can just own land in every state under the threshold and not pay land tax? Darius from 5-6 years ago would say, yeah, that's what the case is. That's what the law says. Okay. And this is probably the key example. Again, I have a Queensland bias here, but we've got a Queensland home. You got a Queensland investment property, Victorian investment property, and one in New South Wales. Because each of the values are below the tax-free thresholds, minus the home, it ends up being you didn't pay any land tax. Now, to just answer some questions, if someone is asking in the background, what about the house? That's over $600,000. In most states, your home is exempted from land tax. So, if you've got that beachside, harborside mansion, okay, that's worth millions of dollars in land value. The good news is you don't have to pay land tax on it if it's your home, okay? Now, if you do have that beachside holiday home in New South Wales and you decide to have an investment property in Queensland, well, that might actually do you some harm, okay, which I'll get to. Before we do that, though, there is a question. Why make these changes? And I've actually extracted a sentence that was outlined in the guidance documents that came through with the legislation. They want to make it more fair. They want to make it more fair because for the property investor that put all their money in Queensland, they would have to pay land tax, while someone, if you want to call it Mr. Smart Investor, who decided to just, or creative investor, to split it across the states, that person didn't have to. So if we're trying to put numbers on that example, had someone bought 3 investment properties in Queensland with a similar land value, that person in Queensland would have to have paid about $8,500 worth of land tax, off from $1.25 million worth of land. But because the person was a bit creative, they managed to get off scot-free. Okay, so that's why these changes were introduced. They claim it to be, it'll just be more fair. Okay, so I guess the question is, well, how are these new rules then assessed? On the next slide, it'll kind of just give you the little process. All you need to do is just go tally up the value of all the land Australia-wide. You apply that based on the general Queensland land tax rates. And the good news is that's not how much land tax you pay. No one's asking you to pay land tax for the property you have interstate. So you apportion that number based on how much you have in Queensland. Okay, so it's kind of just going, let's just apply the general rate, and then you only apportion it. So, for example, if you have nothing in Queensland, this doesn't affect you because you don't have anything in Queensland to pay to the Queensland government. Okay, the more you have in Queensland, the higher it is in that regard. So, running these new rules based on that prior example, you've got $1.25 million worth of land. As we spoke about 2 slides ago, you're paying about $8,500. You just apportion that based on how much of the land is in Queensland. In this case, $450,000, which is the value of the Queensland investment property, over $1.25 million. The land tax here is about $3,000. Okay, as I'll just reconfirm on the next slide, no one's asking you to pay tax again for what you have interstate. It's just going, you have invested there. Imagine if you had done it in Queensland, think you should have at least factored that in. Okay, so it's not the full amount. Okay, before I go into some examples about what's not changed, I'll try to put this in everybody's shoes. If you're based in Queensland and you have some interstate property, be aware that if you weren't paying land tax, you might, or maybe you might pay a bit more now because of what you have interstate. If you're based interstate and you have some Queensland investments, we'll just query, is the hassle worth it for you, or do you want to not bother with it? Because the only reason why you bought one property per state is to get around the separate thresholds. Okay. What I would add though, and here's kind of the good news, I didn't want to lead with this, but I would just add Queensland is still one of the more generous states when it comes to what we can do for land tax. If you subscribe to the belief that you should have one property in one legal entity or one structure per property you might have, these changes do not actually affect you, because what they do is they look at all the land owned by a certain landowner. And if you have different structures, you have different landowners. Okay, so by having one property per structure, the structure that owns your Queensland land shouldn't be holding interstate land as well. Now, that being said, I know there's some people who, just like the individual example before, they decided to use trusts in that same way. I never recommend that, because for asset protection and sometimes succession planning, it does become a bit of a hassle. But if you subscribe to best practice, one structure per property, these Queensland land tax changes do not actually impact you. And likewise, if all you have is Queensland investment properties, or you don't have any in Queensland, these will not affect you. So on to some examples.
And I hope we didn't miss that bit. That was the clincher there. And that's what we're going to talk about with Tony further on as well. So the double taxation, Darius. So how does that work again? And say
so if I could put this in the easiest of example, you're not paying for land you have in Victoria. That's why there's an apportionment. Okay. But to maybe put it even more simply, imagine Australia had a uniform land tax legislation. That $3,000 is paid to the Queensland government. You wouldn't be paying the amount allocated to the different states. So, if you are paying some land tax in New South Wales, it's not like you're going to pay for that land anyways, because they've apportioned it. They just go, how much of that land is based in Queensland? So we'll apportion it based on that amount. Okay. I'll give some examples on just like when people might not be in too much issue here. So on the next slide, if all you have is property in Queensland, it makes no difference. It's the same calculation both ways. Easy enough. On the next slide, if you've got many different investment vehicles, as you can see here under the old Queensland rules, that trust that has that Queensland investment property, $350,000, is within the threshold. Under the new rules, there's nothing that has changed. You don't factor in the property that you have interstate held in trust to or held by the individual. Okay. There's a funny quirk with how Victoria and now South Australia treats trusts. Okay. But I won't go into too much detail with that right now. If all you have is interstate property, as you can see here, well, there's nothing you would have had to pay in Queensland anyways. Okay. I want to touch on a few things. It does sound like bad news, but look, I would honestly say it isn't. In Queensland, we still have the ability to use trusts to acquire property. And even though the tax-free threshold is $350,000, it's better than zero. Okay. So, for example, New South Wales, you don't get a tax-free threshold if you purchase something through a trust. So for all those folks down in New South Wales who have invested in property through trusts, they're doing it because they can see the bigger picture. They're doing it because they can see this offers me some protection in case the tenant gets grumpy. This offers me protection in relation to any risk I have, so it doesn't spread to my investment property. They might look at it and go, this allows me to decide which child of mine I'll give that property to. So what I'm saying here is they're looking at the best way to acquire the property for more than just land tax purposes. There's a bigger reason to it. Okay. I would add here, again, just to emphasize, Queensland has it quite good. Victoria and South Australia, although they haven't gone to the degree as New South Wales, if you purchase property through a trust in those states, unless you effectively nominate an individual to have the property values allocated against, their tax-free threshold is $25,000. Okay. And Victoria and South Australia is actually a good example because until 2 years ago, South Australia didn't have these rules that would effectively tax trusts holding land. Okay. But about 2 years ago, South Australia said, we need to reform our land tax legislation. And what they actually did 2 years ago is they reduced the top tax rate. Okay. But what they actually did as well is to then say, if you have trusts holding property, you need to allocate that trust to an individual, and then that individual will pay land tax on property. Okay. If you didn't do that, there's only a $25,000 threshold. And I want to point this out because if someone looks at what we've done in Queensland in a few years' time, they might go, well, that's great. Let's try to do what Queensland has done because, yes, it does seem to be a bit more fair. Okay. There's other things these states have done, New South Wales, Victoria, South Australia. If you buy property through a company, which is not normally recommended, by the way, so don't do it. But if you buy it in those states through many different companies, they have a way to just treat all those companies as being one landowner and bringing it all into a single pool. Okay. I want to point this out because as far as it has been for me, for about 2 years now, I tell people, and the talk has changed from when I talked about land tax 5 years ago, at least for people in Queensland. 5 years ago, it used to just be like, well, this is all great. No one wants to touch it. 2017, 2018, 2019, 2020 has come along. Suddenly a lot of money has been spent. People are now maybe trying to think, well, how can we maybe tweak little things here or there? Okay. So the bigger thing, which I'll touch on the next slide, is structuring for land tax isn't dead. On the next slide. But there needs to be more to investing in property. There needs to be, well, what are all the other reasons why we care about buying the property in the right structure? Okay, asset protection is a big one. Contrary to what people might think, having tenants can carry risk. Okay, on the other side, having property in your name carries risk for the property. If you get sued, okay, maybe you hit someone while you drive, so don't drink drive. Okay, maybe you're in a high-risk occupation and you get sued in your professional line of work, so don't have property in your name, which Tony will touch on. Okay, for some people, succession planning is a big factor on how to structure things. For other people, it's the ability to income split, whether that's income split, rent, or gains. Land tax isn't the be-all, end-all. It's actually, in my view, it's number 4 on the list of things we should care about. If you can get it, that's just a bonus. Okay, but it shouldn't be the predominant thing, because there are anti-avoidance schemes and provisions out there that could just look to say, well, you're only doing that to avoid it, so we'll just capture you anyway. So do look at the bigger picture. At the end of the day, the bigger picture, and I don't have the numbers to back it up, but you ask any accountant, they would say, if you structure it right from the start, you have the opportunity, and probably from the lawyer's perspective, if you structure it right from the start, you have flexibility. And flexibility, it costs money. Okay, it's hard to get that flexibility. Yeah. So if you don't use the right structures, until at least stamp duty gets abolished, which actually New South Wales was thinking of doing, they kind of backtrack it. They're going to abolish stamp duty and introduce more land tax. Okay, but they went back from that. But until you abolish stamp duty, flexibility to get into a flexible structure, there will be a high bar tax cost to do that. Okay, so I'll leave it there. Hope that was of some use. So just a big refresher. Okay, if you have property in your name, or if there's a entity or person that has both Queensland and interstate property, these rules affect you. Okay, the big golden ticket: 1 property per trust. And just a quick note on that question: it probably won't be, because it's past.
And that was the question: can this law in Queensland be overturned? Darius said probably not.
And if I just make the comment on that one also, if you can think about it from any government, like, this is just easy money for them. Okay, no, and more importantly, the state governments have a track history. Okay, those South Australian changes, that was done by a Liberal government, so they must like money too. The New South Wales introducing a flat property tax by abolishing stamp duty. And, property tax over 10, 20 years' time will ultimately be more than a one-off upfront stamp duty. But that change, again, another Liberal government. So I don't think people don't like money. I think people like money. So this is an easy change. And like I mentioned, the comment at the start is it's a... They see this as trying to make it a bit more fair, because the person who purely invested in Queensland is a bit hard done. On that other question?
The next question was, how do these changes impact developers or projects? I guess similar to, it's just if it's considered an investment. It's
a cost. So two components there. Okay. Projects and developers are a bit more different from smaller investors. people like bigger developers, they will have special purpose entities buy a block of land, do the development, and sell. This isn't legal advice, but there's a very good chance they're not going to have a block of land in New South Wales in like a company or unit trust, and then buy a block of land in Queensland in that same company and unit trust. Okay. If they did do that, which is not recommended, these changes would impact you. But if you did what every other proper developer does, and you just create a new trust or company every time you do a new project, and again, that's actually a risk minimization reason. Okay. If you do that, these rules don't actually impact you. And the second component to that is if your time frame to do these developments are 1 or 2 years, it's just a 1 or 2 year cost, because by the third year you'd have sold everything, you're out. Oh, okay, who knows?
Yeah, so I'll just add a little bit on that from an accounting point of view as well. Definitely, the objective in terms of land tax is just you've got to factor into your feasibility and your cash flow. So you effectively built in the actual additional land tax component within that financial year or within that sort of land tax period that's going to show up anyway. So it's part of basically cost of doing business anyhow. Yeah, that's pretty good. So definitely, I think, Darius, you touch on a lot of great golden ticket taken away. Number one, obviously, one property per trust. Certainly, I think from a long-term perspective, definitely you need to plan strategically or plan with the end in mind, where you could actually making sure that you structure yourself not only for asset protection and long-term succession planning, but also structuring in such a way that you can pass on the property portfolio to the next generation. And, you know, if you really value asset protections or even just structuring from a long-term perspective, land tax is part of the natures of actually holding an investment. I just want to share a really quick one before Cheryl sort of share some of her comments, is that one of my wealthy friend, in fact, we just got a bunch of valuations coming through, and I just started remembering one of my friend was sharing with me in a sense that when you got a $10 million property portfolio, usually an average property back in those days about 100 grand, right? But if you got so you had to buy an expensive property back in those days, like $1 million. Now, back in those days, we generally use a rule of 72, meaning property double either every 10%. That means, grow at 10%. That means it will double every 7 years, or 7% double every 10 years. So one of my mentors was saying, you just got to buy a $10 million property and say a blessing, right? Every time you reverse your car, looking at the property, and 12 months later, fair enough, your property is going to increase by 10%, being $1 million. So that's what, 100 grand. Now, if you are paying land tax, say 10 grand, for these people, they just treat it as a cost, because they reckon, look, I've got a property's gone up in value, call it 5% or even 3%. So it's still going up. Obviously, it's just the cash flow issues that you got to maintain to pay for it. But certainly, if you structure correctly, like Darius mentioned it from a legal perspective, certainly your aim is from a succession planning, asset protections, and minimizing the legal opportunity for someone to try and have a attack with you. Therefore, there's a lot more opportunity for you to hold your asset. Yeah, no. So certainly my golden ticket takeaway is that you definitely want to go around using the right structure potentially to protect your asset, but also using different structures to own different property. Doesn't matter in whether it's in Queensland or is in New South Wales specifically. Yeah. What's your takeaway, Cheryl?
Well, I mean, I think the main thing is that to not, what Darius mentioned as well, is like really in the larger scheme of things, it's a change, but it's not like a significant change that's going to be a deal breaker. Effectively, it's a cost. You just have to factor it in. Is it a huge change? Not really. You've got to weigh up all the other benefits. And there are obviously ways around it, and that's what we're going to dive into, is how do we ensure from a tax perspective the right structures to be able to minimize the amount of tax that we're paying, which is what we're going to dive into. Because again, if you've got the right advice, then you are going to save yourself paying unnecessary tax. But it is not the be all and end all. It is just an extra cost of doing business. If you're getting an investment, it's just factored into it. So let's dive into it, Tony. Actually, could you?
Can I? Oh, okay. So, Peter,
Yeah, I
do a share
can.
screen.
Yeah,
Oh,
I've got.
Can you
You've
see?
got
Can
the
you see
screen
now
up.
or not?
Yep, the screen's all up. Why Aussies love trust.
Oh my goodness, one of my favorite topic. Hey, I've been waiting all day to tell you that. Hey,
So have
why
I.
Aussie?
So
And
have
in fact,
I.
I almost changed the subject headline.
T is
Why?
for trust, not for Tuesdays. T is for trust.
Yeah. I got quite a few ideas already, but we're gonna go pretty fast as well. Thanks very much, Darius, to touch on the land tax, the structuring, and how you could definitely use structures in a personal name to minimize your tax. Still can, particularly in Queenslander. And I think as a Queenslander, I live in Queensland. I own quite a number of property myself, certainly in around the trust structures as well. I remember my mentor actually mentioned to me, trust is critical foundation. So you got to think with the end in mind. So that was a really good advice I took on many, many years ago. But we're going to share with you also, now in the interest of time, I got 5 principles to share. I'm just worried that I'm speaking too fast and I might be sort of losing in getting the quality of the information sharing. But maybe in the interest of time, I'm just going to share 1 out of the 5. So I guess with your viewer, if they're interested to get the rest of it, just pop us an email. I'm happy to send a PDF copy or slide for the rest of it. But certainly I'm going to touch on at least 1 out of the 5 principles in terms. And also I've got just 1 real life example. So if you stick around to the end, I'm going to share with you also the practical example on how rich folks and particularly Aussie use structures to manage the property affair and also minimize the tax, right? So one thing I do want to just touch on really, really quickly is that I really believe, as Aussie and I, or at least being an accountant in a lucky country, we believe that every Australian, in fact, every Australian really has the right to have a good quality of life in their retirement. And we also really believe that every Australian really should have the right to also take control of their financial destiny. So one of the things that I want to look at is that how can we basically better have a much more better understanding of a trust structure? And there's been really a lot of interest probably in the last couple of months as well, particularly with land tax coming along. So that's a topic that I'm going to sort of touch on why Aussie love trust and also use a practical example to share with you how a combination of a trust and a superannuation or a super fund can be very, very amazing working well together. So before I do that, I just want to sort of share with you guys that there are some frustration, particularly when it comes to property investors. And one of the frustration, by the way, Cheryl, can you see the slide changing or not?
Yeah, we can see the slide. What I might get you to do, Tony, just right at the bottom of your screen, can you click so that it's a full screen?
Oh, actually, I can't remember because if I do full screen, I lose the other screen. I think we tested before.
Okay. Yeah. All right. Not a
okay.
problem. Not a problem.
Can you see the screen, right? Yeah.
Yes.
So look, as I said, one of the frustration or biggest frustration is that we tend to basically getting the wrong structure. What it means is like in terms of getting a wrong structure is that sometimes property investors or property buyer, they get a bit confused, right? There's a lot of people out there that actually hold things back because they cannot get the right structures or the right advice around what they want to do. So what we do is that we assess where you are now, where you're going, what's your current situation, and tailor specific understanding your strategy and the right structure to actually focus on your actual circumstance or your outcome. So when you actually get the right, as I say, fundamental structures correctly, often when people kind of like, particularly property investors, right, they want to achieve their wealth creations or building wealth by having multiple structures. Often the problem I find is that when they attend so many seminars, guess what happened? They pop out the other end buying lots of multiple structures that really not sort of structure for their circumstance or the current situation or the outcome. So when that happens, where they're not really structuring to achieve their financial affair or the outcome. Now, when this actually happened, this is actually some of the common problem I see, that people are trying to actually build property portfolio, but with a wrong structure in mind. Just because everybody got a trust structure doesn't mean you should have a a trust structure as well. So what happened, I see often as an accountant over the year, is that you actually struggle either getting a better finance deal or getting a borrowing arrangement to help you to grow your property portfolio, or at least if you don't get the right structures, you probably end up paying a lot more tax than you should be anyway. So that's probably one of the biggest frustration that I see in people actually getting a wrong structure. So the other things that I'm also fearful about is that there are two other fear as well, right? So first thing first is that they fear that they work really hard to build their property portfolio, but they fear that they're not making enough money or the passive income for the retirement, or at least get ATO audited if they don't get the right tax advice, which we don't touch too much at the moment, particularly for property developers or renovators on GSTs and margin scheme. So one of the things that I believe is that what you got to do is you got to actually making sure that as a property investor, you want to make sure that you choose the right entity, because choosing the wrong entity, it means, like Darius was saying, flexibility might cost you a bit of money, but not having the flexibility, understand your taxation situation now and in the future, such as future capital gain and cash flow, you might lose your opportunity where you might be taxing a lot more when having a property in your name, because your future capital gain tax can hit you really, really hard. Alternatively, we see some people buying a property with a view to make a joint ventures arrangements or property development, either buy and sell or buy and keep. When that happens, if you got the wrong structure, any future changes and transfer in dispositioning the property, you will probably end up costing you a lot more money in stamp duties and extra income tax as well. So what you want to do is buy property under the right structures, or choose your structure wisely, okay? Now, the other area that I thought is quite an interesting one is that I want to touch on really quick, and I want to use a real life example to wrap around it so you can actually see the real kickers out of the actual structuring and the combinations of having not only better control, asset protection, but also flexibility with taxation, how trust can be really wonderful, giving you the amazing opportunity, particularly for tax plan, but also protecting your asset. So one of the things that rich folks also do is I noticed that over the sort of a practicing year is they're really big on the concepts of control rather than ownership. So I've touched on really quickly, and I might just pause a little bit because I do have a few slides to jump in, which is the 5 reasons why Aussie actually love trust, right? So one of the things that I noticed that rich folks, particularly wealthier investors, are talking about structuring around is really they understanding the concepts of control. Now, concepts of control, I'm going to just give you a bit of an example in terms of what's the difference between the concepts of control or ownership. Now, when you have ownership versus control, ownership is like, as a typical human being, right? We technically tend to have the tendency that we want to own everything. We want to own cars in our name, our boats and our car, even our dogs, right? And so when you actually have a control over ownership, let me just rephrase this. Control over ownership carries no taxation. Let me repeat this, right? Control over ownership carries no taxation. Now, what it means is this. If you are willing to just relinquish or give up the ownership while you actually having a full control of your assets or your investment, right? What you're actually able to achieve is a greater opportunity of having more wealth, more obviously asset for you to control, because significant of those asset components are not actually lose in either income tax or land tax if you manage it well, or even future CGT, capital gain tax, right? So essentially what I've learned is a really critical outcome in terms of looking at some of these wealthier investors. They actually use company trust structure, maybe in a form of control rather than ownership. All right. We're going to just use an example to wrap around that at the moment now. So the last thing, as I said, I want to touch on just really quickly. Now, we might not have time to go through every single reason, but these are 5 reasons, Cheryl, right? You've been waiting for it all day, right? And there you go. So, I told you probably already know.
Life is complete. My day, I can go to sleep comfortably and in peace now.
Absolutely. Yeah. Now, I promise you, remember, I touch on as brief as possible, but also I'm going to use a real life example, a practical example to wrap around it. So the audience and the viewer tonight absolutely going to get some nuggets out of it and understand why trust is good. Trust is a friend. trust can be complex, but if you got the right people, like Darius was saying, I love it when Darius mentioned about flexibility and complexity. And yet, absolutely, sometimes flexibility and complexity come at a cost, right? But it just means that if you got the right advisor, you shouldn't be worried about it. So 5 reasons, there you go, 5 reasons why Aussie or rich folks actually love trust. Now,
Tony, before you dive in, if you don't mind, we've got a
Yep.
question here. Often your situation changes over time. What might have been a good structure 20 years ago ends up not being beneficial. How do you deal with that?
Darius, you want to have a hit on this one?
Yeah, I'll make a few comments. Okay. And actually, if I can catch up on a few of the comments. So the George Hong one, can it be challenged in High Court? He's referencing the Queensland changes. I doubt it. Long story short, because Queensland can make whatever changes they want to the tax rules. There was another user question about 10 minutes ago. How will the Queensland government know what you have interstate? Yes, I've answered that for George. Okay, so the next one, how will the Queensland government know? You need to actually notify them that there's going to be an onus for you to update them. Now, not everyone will know. They might hear for it the first time when they get their land tax assessment. Presumably, and I'm just trying to assume what they might do, when you get the assessment next time, if you do, okay, if you do get an assessment, you have a month to update them. Now, if you don't get it, if you've heard this speech right now, don't put your head in the sand. Do tell them when the time comes. And the answer to, well, when is the time to tell them? It will be after next 30 June. Okay, so maybe just wait till 30 June next year. Their website might be updated to outline the comments about interstate holdings. Okay, so it's still all quite new. Like I said, you won't see these changes in the actual legislation yet. So it will be closer to the time. Presumably, there will be some penalties if you intentionally do not disclose. Now, the other main one, what's a good structure? Look, I can say this because I've seen this through a structuring perspective. Okay, Tony talks about using trusts. I know he maybe haven't mentioned much about company, but trusts and companies hand in hand provide, in one way or another, a level of asset protection, flexibility, tax planning. Okay, and knowing the clients who had trusts over 20 years ago, they're in a better position now for using those structures than they were than if they didn't. The rules in relation to trusting companies, again, will change. And it's like I mentioned again, you need to look at what they can offer you. And if you value those benefits, use them. And the big one, like Tony mentioned it, I mentioned it, the trust structures, well, what we call a discretionary trust, they will give you the most flexibility. Yes, they're very complicated. Yes, there's a lot of legal things to appreciate as well, but they do give you the most. And some might say, if you do not know what it will be in 20 years' time, your situation, having the flexibility to make that decision 20 years from now, that might be the better option than to not give yourself that opportunity. Okay, if I could just add that there. All right. The thing with trust, and if you ask me, well, how does that work? How trusts really kind of work is they're kind of seen as a look-through entity. So with a trust, there's an end beneficiary. If we're talking from a tax perspective, okay? In 20 years' time, the trust will decide who from a bunch of beneficiaries will benefit, okay? Whether it goes to the key person who set it up, or whether it goes to that key person's lineal descendants. That's the call for whoever manages that trust. But the point there being, if you do not want all this added complexity, just don't use it then, okay? But you do not definitely get number 1, number 2 to a degree, number 3, and number 4. You will definitely not get 1 to 4. If you use these trusts, it's kind of like the land tax thing. you're gonna get 1 to 4 definitely for the next few years. So there's still benefits for it now, anyways. Okay. If that can answer that question, if you
I might just add. So I'll give you an example. A client 20 years ago, let me imagine they bought a property 100 grand. So 20 years later, property is probably worth a lot more money. And if you think about it, 20 years ago, you used up all your negative gearing, all the property might have been at least producing cash flow positive. Alternatively, you definitely got capital gain if you got property over 20 years, right? So initially, probably the first 20 years, I always say sometimes short term, kind of like you don't see a lot of benefit in trust, but on a long term, you see the benefit. But unfortunately, you got to think with the end in mind and have that reverse psychology or the reverse engineering and understanding that the trusts are benefiting for a greater purpose or as I said, bigger reason point of view. So if you got bigger capital gain, 20 years ago, you probably would not have kids and you probably both husband and wife working, mum and dad. 20 years later, you don't know situation. Ultimately, the planning is that you don't want to work, you want to retire, and you hopefully in a lower marginal tax rate, husband and wife, or you might have kids like myself that's over 18 now, and you don't actually work, right? Or the kids are still at uni. So that's where you got an amazing opportunity where you got now multiple, lower marginal tax rate, where if you do sell the property in the trust for the sake of planning or future successioning, at least you got better opportunity to plan for your capital gain. Does that make sense?
Yeah, absolutely. So Tony, we might as well dive in, and I'm just conscious we've got probably about
absolutely
10
just a quick
minutes.
one, and then we go straight into the example, right? Yeah, I'm super excited on this one. As I said, I can't wait. Look, I think as I said, first and foremost, asset protection, it's a dead giveaway. One thing I know over the many years practice is that wealthy people, rich folks, sometimes we call them, they begin with the end in mind, knowing that they're going to be quite wealthy. So you've got to imagine that you're not wealthy in today, but you're going to be wealthy in the future when you become that super successful investors, right? So most of these people actually basically thinking about asset protection and so structuring themselves not in the personal name, making sure they use instead of personal name, rather than that, they use a company trust structure, right? So what I see a lot of things that you don't want to work like our parents, right? Work so hard all their lives and have the money just either taken away for a crazy, silly, basically claim. But what you want to do is put all your hard-earned asset in a trust so it get locked away, and basically it's not available for any creditors if you've done it correctly. Right now, the second one, just really quick one that I like about, we touched on briefly about controls and privacy. Probably one of the things I want, like what Darius mentioned earlier on also, is that when you talk about control and privacy, is that the legal ownership, remember we talk about control and versus ownership, right? So when you actually control your assets, the real legal ownerships of a property is actually the owner of a trust is the trustees, which is the corporate trustees. Like essentially what Darius mentioned, if you use a corporate trustee, which is a company as a corporate trustee, you got the added asset protection or limited liability. So when someone trying to look into who's the ownership or who is the controller of that trust or of that property, it's really hard for them to see as an outsider unless they pay really good lawyers to dig into really hard, right? But even that, the trustees are not available for the public anyway, right? So when you're trying to look at who actually control the trust, you won't be able to find it. So that's another sort of a good reason why I guess people actually, Aussies, really like trust, right? Now, the last one that I want to touch on a little bit is the combinations of the flexibility and tax planning. As Darius alerted earlier, when you got a discretionary family trust, is probably one of the most flexible structure available in Australia. So we're going to touch on that as a real example, because when you have that trust distribution being a trust profit, you got the amazing opportunity to look at as a husband and wife, mum and dad, or any kids, even including a corporate beneficiary. We're going to touch on it, whether or not year round we can actually distribute however we actually like to see fit, right, as an accountant. So the other things that tax planning is probably one of the biggest one. This is probably one of the most probably somewhat also the main reason wealthy investors or rich folks actually like to use trusts, because you can actually legally avoid or stream your income or split your income to minimize your tax legally. Like in a minute, we'll show you the real example. Maybe perhaps what I will probably do is jump straight into this little example. And these are real life example on how you can actually use a family trust and a super combo to achieve an amazing outcome. Yeah, should we look into that, guys?
Yeah, let's dive in.
Okay, now really quick one. So then we can go into a lot of maybe a Q&A. So this is just how it all come together. So if I just look at it, number one, we got a background. This is a real life example, by the way, right? We got a background situation. You know, average family, mom and dad, they all get together, put all the money together. They want to buy a property. Man, just remember, you got to be very clear what's your ultimate outcome, right? You got to actually know that you made a decision you want to be a millionaire, or you're going to create that passive income that you deserve for, remember, right? Now, so the background is mom and dad, you know, kids all get together. They want to buy a property, or they want to do a quick renovation. They want to flip it. They know they're going to make a few $100,000. They got a bit of problem, obviously. They don't know what's the best way to structure, or they don't know how much tax got to pay. And so they need a solution, and they have a very clear outcome that they want to pay as little tax as possible legally, yeah, and structure it correctly so they get the flexibility, a better way to control the taxes, and also maybe looking after mom and dad, getting a little bit more senior into the future retirement saving, but also just making sure that the structures allow them to cater for their flexibility. So let's have a look at really quick example here. Now, can anyone see that? Can you see the slide?
Yeah, we can see it.
This is a really quick one. So the property, basically, it's as I say, strategy is buying, renovating, flipping for profit, right? We're not going to touch on GST in the interest of time tonight. But the way that we structure, so number one is strategy, very clear that we're going in to make money and we're getting it out. Number two is the way that we structure. Family comes in. Remember I said to you, all the family want to get together. There's no external party except a bit of a joint venture project management team, which is an external company. We're just going to pay a management fee anyway. Mom and dad, I should say there's son under 16. There's another son over 18. So mom and dad are not working at the moment. And, you know, let's just say a significant individual. Let's call it a sister instead of a additional girlfriend, right? And so, but again, you know, this is what trust do, gives you the flexibility. So as I said, one of the objective what you can achieve under this trust structure is number one, you're definitely looking at that you want to protect your asset, right? Secondly, you want that flexibility and also access to that small business taxation, but also get that flexibility and better control. So let's have a look at the, so that's the background, okay? Let's have a look at the problem that I'm having. Now, you can see that when this property development or project renovation deals happening, this is real life case, by the way, right? So if you're making $233,000 in profit, just on a 50% marginal tax rate, you're looking at just over $100,000 tax. So that's a big problem we have. Would you agree with that?
Yeah.
Okay. So without any planning, as I said, if you buy it in a personal name, easily that $233,000 is split between A and B as an individual name. Yeah. So if it's in a company, it will just be taxed at 25% tax rate. But if it is in a family trust, have a look at see how amazing when you use the combinations of super and a family trust, you can quickly see that you can actually see an amazing and real saving there. So with that $335,000 profit, so instead of paying $105,000 tax, what we do is that we might employ 16-year-old and pay him a $30,000 income, okay, legally. And obviously there will be tax involved in that. We might distribute $37,000 to daddy. We might distribute $37,000 to mommy. We definitely can distribute $37,000 to son over 18. And as I said, the son under 18, 16, and we just pay him proper wages. And I will say that, yeah, the sister of the father is actually not earning any income, living in Australia, not overseas. So we might pay her $37,500. Now, what do we do? The difference is that we might, remember I said to you earlier, these two individuals, they want to look after the mom and dad as well. They don't have a lot of money in super. So they want to whack in a big portions of a $25,000 into a superannuation contribution, which only be taxed at 15%, right? Now, so you can see that by doing that type of strategy, paying the first 16-year-old son at 37, the second, third, and the fourth and the fifth 37 to the other family member, your trust is effectively, after the contribution to the super is almost zero. That means you don't even have to distribute to a bucket company or corporate beneficiary, right? Because you don't even have to do that. Reason to that is the effective tax is only 10.37%, or the overall tax that you actually have to pay is only about just under $25,000 instead of $105,000. Do you get that?
Yeah.
Are we together? Yeah. So
Yeah.
if you look at it, there's definitely a whopping saving of $81,000, right? So essentially, if you distribute $37,000 to mum and dad, the only tax that you got to actually pay is only $3,375, right? And so that's really, I just say, a demonstrations on how asset protection can put in demonstration, but more so, you see the flexibility, the amazing tax planning opportunity allow for you, to have that flexibility. Yeah, so that's just one real life example there. So if you think about, the power of amazing bucket company, we can talk about that later on. Where if you do not, we might have some audience might have some questions. That what happened if husband is still, father is still working on a high marginal tax rate, mom is not working, right? And so we can still distribute, not limited to $37,000 year to year if that income keep coming in every year, right? We could distribute to mom and the 18-year-old, a little bit more, so there's flexibility there. Or we can put it into a bucket company. So this next slide here shows you that you can distribute. I did have a questions early on. Can I distribute to my girlfriend if my wife doesn't know? Yeah, absolutely, right? But you just make sure your partner doesn't know.
Don't make your life complicated.
We don't want to. Yeah, we don't want to complicate. Well, that's what we got lawyers for, right? Lawyer will uncomplicate things, right? So that's why we got the lawyers in there. I mean, explaining to us the complex world of land tax, then make it so easy to know. But as I said, if you look at the amazing power of a bucket company, sometimes we call it a corporate beneficiary just for a sexier term. But what it means is that you can park the money in a bucket company if you decided you got no husband and wife, mom and dad to distribute to because they're on a marginal tax rate. Say for a viewer who is already on 6 figures income on a marginal tax rate or a PSI, personal service income, they cannot distribute any more to themselves because they're already on a marginal tax rate. So what we can do is we don't distribute to them, right? We distribute to a corporate beneficiary, which is a bucket company, right? We park the money in the company until when you actually have a lower marginal tax rate, then we call the dividend back to you, okay? So that's the power of actually having a bucket company. By the way, we mentioned about earlier on that 20 years trust structure. Imagine that you have a company trust structure holding a shopping center or property that earning a rental income, positive rental income. So instead of distributed to high income earner individual, you're going to pay tax. You're never going to get your tax back. You put it into a bucket company. Okay. So that's another way of how rich folks is doing. Yeah. So any good questions coming through at the moment?
We do have some questions and comments. So question here, can you add a bucket company at a later time?
Okay. Is that legal questions or maybe a tax question? What about,
I'll make the brief comment from a
I pretend it is a legal question. I'll get Darius
if you want, Tony.
I'm having a bit of a scotch.
Look, trust can be flexible. Therefore, yes, is the short answer. Now, that's the short answer. The long answer is whoever sets up your trust, make sure you go through someone who knows what they're doing. Okay. If you're going through someone who doesn't know what they're doing, knows the answer. But any half-competent lawyer and accountant will make sure you can do it.
And then we had a very practical comment there back to your wife and girlfriend. That's the fastest way to lose half your net worth.
Absolutely, yeah, I like that one. The last advice someone else to give it to me is don't get divorced. Okay, so that's coming from a lawyer and a client. Amazing. If you don't, I do get advice from my clients. So thanks very much for the viewer. Yeah, okay, that's a good one. We've got to give the viewer asking the questions or giving us the tips a prize, eh?
Absolutely. So what's this here? What's this case study showing us?
Yeah, so I promised you earlier on that I will share with you our own real life case study and example, and this is one of our real life projects happening as it is right now in Brisbane. It's in a suburb of Urimpili. Look, as I said, you put a team together. We know we have a clear mandate, meaning clarity about what we're going in, what we're coming out. We got the right sort of structures in mind. We understand exactly what we're getting out of it. So essentially, it's just a one piece of dirt able to actually zone. So the critical thing is make sure it's got no character zoning or restriction where you can't get rid of the house. I was actually mentioned to Belinda Smith, our great friends, do specialists in renovations, right? I'm thinking maybe we should just renovate the whole big house and then see how we go from there. But all in all, she mentioned, so what's your goal? I said, well, maybe I'll gut it down. I got a DA for 3 and then build a 3 beautiful house, either to keep it or to sell it. And so one of the things that we're considering is a strategy. So number one, buy and either buy and hold or buy and sell. So if you buy in the instant, I can buy and build and keep it, or I can buy and build and sell it if I wish. But so here's the structure look like. We decided that, look, there's 3 brothers and sisters. They all get married now. They're not sort of young and single, still living with mommy and daddy. And so we basically decided that, you know what, in the instance, I can either set it up as an example, one for mommy, one for daddy, because they want a separate ownership entitlement. For some people, they do. For me, it would be like one for myself, one for my brother, and for my sister. And basically, we own this property. So how we looking at that is that any other profit that come in, I can distribute it to each individual family, respective beneficial or kids and individual member or their significant person. Alternatively, I can pop everything else into a bucket company. So that's how we use the structure. The reason is, remember I said to you, one of the reason also why Aussie love structure is that they want flexibility. So if you think about one of these master plan of wealth that we have sharing for over many years, is that I can actually distribute any profit, not losses, guys. So you cannot distribute losses in a trust. It gets stays in a trust. But if you, from an accountancy and tax point of view, if I got a profit in a particular trust, make sure that you get a proper advice and review it correctly. I could distribute how flexible I want to in terms of across other trusts or within my family members or even to a bucket company. So that's one of the demonstrations on flexibility. So it's not exclusive to one trust. So I remember earlier on, one of the golden tips or the golden ticket that Darius was sharing is that you really want to put maybe at least put each property in a different trust structure. And by the way, you notice that building, I'm actually talking to you guys literally right underneath here, because that's one of our building that we operate from. So imagine that just for the viewer also, maybe I'll get Darius to touch on it, particularly on land tax on a self-managed super fund. So just understand that the self-managed super fund, when you roll over your super into a self-managed super fund, buy a commercial property or a residential property, the self-managed super fund is actually considering as a trust structure, right? And therefore, it in itself is a separate entity, and it's got its own little threshold within the Queensland rule. Darius, you want to touch on a little bit just on that part?
Maybe not tonight. It's quite complicated. Yes, we're getting quite late
for another session.
We've got a few more now. So just really quickly, before any viewers start hitting us with any questions, a bit of a structuring suggestion. Actually, I should just say that not an advice for a structure. Is that as Darius sharing with us tonight, companies are there really for asset protection as well, because it gives you that additional layer, but also the what do they call? I think it's limited liability, right? Is that right, Darius? Limited liability?
Yep.
Being a corporate trustee, yeah. Trusts are, as you can see, trusts are wonderful. Trust is your friend, and trusts are there to save you money. So number one, I think, definitely if you're thinking about using a trust structure or buying a property, investment property, definitely one of the suggestions, and if anything that you take away today is that get the right entity from the start. All right, that's number one. Number two is obviously considering asset protection before everything else is stuffed up, yeah, or before you get sued. Otherwise, it's too late. Okay. So just a quick one. I do put together a little slides about 3 steps. So I really think that what we believe in just here tonight is just to helping other people as well. Okay, helping you to help other people. But the 3 steps to have the right structure, I think. Look, number one, you really just got to make a decision. Right? The viewer just got to make a decision that I deserve to be financially free. I want to be rich. I want to have that desire financial passive income. So that's number one. I believe that you got to make the decision, believe in yourself. Number two, you just have a clear strategy. Like, what are you in it for? Are you buying whole short term? That's a business decision. So you got to have the right structure. Are you buying whole? That's a long term. You need to use a company trust structure or even an SMSF. Number three, just like Darius is saying, get a good legal advice or get a good accounting advice or structure advice. And I think you are almost there, home whole. And I think that's the next slide you're looking for, next steps, okay? So look, just wrapping up really quick. Certainly, I hope that you guys get some value out of tonight. If we got some questions, have we got some questions coming through at the moment, Cheryl?
I can't see any questions, any further questions from what we were.
Okay, we're almost at a home stretch, right? Certainly, look, I think if a viewer wants to get a lot more clear about the strategy on how to make more profits, or even just getting the right structures in place, or even just the right tax advice, just pop an email to Darius or myself. If you particularly want the balance of the 4 principles that we're teaching tonight, which we don't have enough time to go through everything, certainly if you pop in an email, we'll send it through to you guys. And wish you guys all have a great, fantastic night.
Fantastic. Thank you so much to both of you. We've got some comments here, I guess showing some appreciation for the time that you've put into these presentations. Darius, Tony, that was really, really valuable. Again, for anyone that wants to know about how the Queensland land tax changes will impact you, watch the replay. And also then in terms of getting, all right, what do we do in terms of trust structures in the second half of Tony's presentation as well. So fantastic. Thank you, Darius, Tony. We'll get some rest, and we'll see you all again, everyone else that's joined us. Thank you for taking the time and for your comments and engaging. Make sure you visit and subscribe to the YouTube channel, The Business of Property, where you can find all our past episodes and get notified when a new episode comes up. So make sure you hit the like button. So until next time, keep well, and we'll see you again soon. Take care. Bye-bye.
Awesome. Thank you very much. Thanks, Darius.
Good night, guys.
Awesome. Good night.